Welcome to the daily update where I'll go over the action in the market for Tuesday, January 21st, and we'll see how things look for Wednesday, January 22nd. Okay, looking pretty solid right now. Some of our indicators are looking a little too solid. Doesn't mean we have to stop going up. It just is something that we want to be aware of. We're looking pretty good in the short, intermediate, and long term. And this euphoria that's been happening, at least in the stock market, has a lot to do with this positive action because of the inauguration. And they like a lot of the executive orders that have been signed to this point. There's been no real mention, or, well, there's been a mention of it, but nothing necessarily official when it comes to tariffs being placed on China. And the market liked that. They are proposing that some tariffs will be placed on Mexico and Canada. But in the meantime, the market seems to be doing really well, looking pretty positive at this time. We're back over to full-blown positive. We were getting a little bit concerned with our smart money indicators. They were starting to go down even as the market was going up, but they switched over and are looking much more positive. What we're seeing right now is more of a broad market advance, which is holding some of the mega caps back, some of the large caps. Now they're doing okay, but they're not really outperforming right now. But the ratios that we look at between the two still show growth outperforming value. All right, let's go back and talk about what happened and then look at some charts. Now, Friday's session, even though we finished up 1%, all of that was pretty much seen in the gap higher open. There wasn't awful lot of movement intraday from the open, high, low, and close. And so the pivot points for Tuesday were not very far apart because the pivot points for Tuesday were calculated based on Friday's intraday move. So it wasn't all that difficult for the market to get above R1, but we did get back above 6,000. And that's one of the things that we were watching after Friday. And I was talking about over the weekend. We need to get back above that 6,000 level. It acted as resistance in Friday's session, which was options expiration. And maybe there's a whole lot of options at 6,000 that we're either going to be in danger of going in the money or staying out of the money. And the market wanted it that way. So we did get above R1 at 6,015, and then we got up to R2 at 6,035, and then we kind of chopped for a while. And we actually looked like we were going to break to the downside there, but some buying immediately came back in. And then what happened is that prices broke above R2. Instead of coming down, we went back up. Now we hit resistance at 6,050, a round number, and that just kind of halted things in Tuesday's session. But then we ended up closing just a little bit below. We're like 6,049 or something, and some change in there. So we closed pretty much at the high for the session, and that's usually a very positive thing there. We were up 0.88% on above average volume, and we are positive in the short, intermediate, and long term, looking a little overextended in the short term, and I'll show you the charts. Interest rates continue to come down, and the stock market likes that. Oil has also been coming down. And a lot of this has to do with the inauguration and the new administration coming in, and the market seems to be liking so far what is happening there. Now, a lot of this is based on emotion, but we are seeing more broad participation across the market. Okay, some comments. We did get back above 6,000. We're now dealing with the 6,050 level for the S&P. And EOs, that's executive orders. There's been no mention of tariffs on China, and the market's like this. But there's also the proposed idea that there's going to be a 25% tariff on Canada and Mexico that is planned for February 1st. We'll have to see if that actually happens. And another big thing is that there was an announcement of a $500 billion AI infrastructure bill. And that really helped. A lot of the AI companies, the whole AI and robotics ETF did really well. And that was another positive thing that happened for the market. Small caps are hitting resistance at their 50-day simple moving average right now. Now, we've been getting a little bit of a key off of small caps. When we were going down, we hit the 200-day moving average with the small caps with both of the indexes that we follow, the S&P index, and the Russell 2000, and we bounced up off of that, and that was providing some kind of support. Well, we were also dealing on a number of different levels and indexes with the 50-period moving average, specifically with the S&P. Well, we were able to get back above that on Friday. Now we're dealing with it with the small caps. Can we get back above the 50-day moving average with the small caps as well? And the bank ETF, this was another one that I brought out over the weekend. We were not above the 50-period simple moving average with the bank ETF. The financial sector has been doing good, and banks have been reporting earnings, but their ETF was hitting resistance. Well, we were able to get above that. Smart money indicators, which were actually looking a little more negative over the weekend, have now switched back to looking positive. And we get one additional chart on our list that we don't see all that often. The rate of change 5. That's the rate of change going back 5 periods. This is showing in the short term, maybe we're going up a little too far too fast. Now, again, this could still go higher. This is also suggesting that there's good short-term momentum. Then we have our usual charts, the ones that if we're going up, they get extreme pretty easily. The Stochk RSI, Williams percent R, CCI 14 and 20. We're also starting to look kind of extreme in the short and intermediate term with the stochastics. This is one that's causing a little bit of a concern right now. We're getting extreme with the S&P and NYSE McClellan oscillator. And then the boom indicator, we're getting kind of far away from the 20-period moving average. We just regained that a few trading sessions ago, and we were below it. That's what was turning the short-term trend to negative. Now we're going up enough so that we're kind of getting far away from the 20-period moving average to the upside. Now, there's a positive side and a negative side to the 20-period moving average study, and I'll show charts of all these things here, is that we got above 70, and that's showing good short-term momentum. But now we're going above 80, and that's when it looks like maybe we're going a little too fast here. Intermediate term, the list is starting to get a little bit longer. The CMB composite just barely starting to register something extreme. The Swenlin trading oscillator based on price is starting to get extreme. We're not there yet based on volume. The PMO studies, which was the only thing on this list after Friday, getting a little extreme with that, and I'll show you the studies chart. And then the Sean trend meter is getting into the initial part where it's looking a little bit extreme. No change to the scenario where the Fed, they cut rates at their last meeting and they say we're done for right now and we're increasing our inflation outlook. So for right now anyway, the market's not paying as much attention to the Fed. They're paying attention to the political things going on with the new administration. The dollar was down and interest rates were also down. This is what's helping stocks. Stocks and bonds have been trading off of each other over the last number of sessions, and interest rates were going up. That was sending stocks down. Well, we closed at 4.57% with the 10-year yield. We're getting closer to that 4.5% level. And after Friday, we had been at 4.61%. Sentiment is still negative, but we're improving. The context is that we're going up. We were at 26, I believe, 28, and then we climbed to 38. Now we're at 41. So the context is that we're getting better. But on the scale of things, it's still in that negative area. We have to get up more into the 40s before we get back to neutral. We are positive now with the trend, but the ADX is still below its moving average. That is common when we're switching from negative to positive for the trend itself to be weakening as things shift over. So we're below the moving average, but we're still above 20. So it suggests a weakening trend, but it is positive. With the update, our bias is positive, and the last few days together, we've been seeing a nice little bounce here, and we're seeing an improvement with our chart structure that I'll go through. And so our momentum is also positive. Okay, we didn't have any economic reports in Tuesday's session, and even the ones coming out on Wednesday are not really market moving. It's going to be later in the week before that happens, and even that list is not all that big. Okay, so looking at Isabel Net blog charts here now. I teach English to Chinese children online, and coming up to the big time of year in China, where it might be Thanksgiving, Christmas, New Year's, more in the US. Well, the Spring Festival is a really big time in China, and that's going to be coming up at the end of January. And they have these animals that represent every year. So it's like whatever year you were born, that's the animal that you are. This year it's going to be the year of the snake. Okay. And so somebody just had a little extra time on their hands, I guess, and just said, okay, depending on what animal is the new animal for the Chinese New Year, how do things perform after that? I put the red box around here where stocks tend to do better under horned animals, and you can't make that up. This is just showing, goats, ox, dogs, at least the dogs I've had never had horns. But snakes, that's what the new year is going to be. And so, anyway, that's just kind of interesting. And then I usually deal with this in the intermarket analysis video over the weekend, but this is the forward-looking PE. We're still expensive here. And you take the aggregate index itself, that's the weighted version of the S&P, and we're over that 20 level. So we're expensive, but we've been that way for quite a while. And I don't use this as a timing mechanism. I use it more as for informational. Where a fundamental investor that uses fundamental analysis, they're really into this. But if you constantly use that, you might miss out on a lot of gains because there are periods of time when the market's willing to be more expensive. And then you look at the equal weight version, that's a little more, it's not considered expensive. We're under that 20 level. We're between 15 and 20. 15 is considered to be fairly priced. We're coming in at 17. Now, this is all before Tuesday's session, so these numbers change every day. Then consolidated equity positioning actually coming down as the market had been under pressure. It's probably going to start to go back up if we continue to be more positive. And then projections put out here by Goldman Sachs. Okay, we've been seeing a nice little bounce here. They think that we're going to continue to go up as far as earnings and think we'll get up to 6,500 here. And then this is the earnings. They're also projecting that earnings are going to continue to go up as well. Global stocks are poised to extend rally. This is the MSCI based on the global index here, where according to this trend line, we're breaking out above this for right now. So that's showing good momentum. And they also have a momentum indicator down here at the bottom, the stochastics right here. Equity positioning across sectors, not really that surprising that a lot of money's going into the mega caps and tech. That's usually where it goes. We are seeing a lot of money going into staples, even though the market's not necessarily getting more defensive. We are still seeing a lot of money going into that. There's people that buy toilet paper and toothpaste all the time. And so you see a lot of money typically going into those stocks, even when they underperform. And the financials, it's good to see this doing well. And then consumer cyclicals, because we look better economically, money going in there. Where we're seeing money coming out of utilities, industrials, energy, healthcare, materials, and then real estate. A lot of the real estate has to do with the rising interest rates that we've been seeing lately. But now that they're coming back down, there may be an improvement there. And red versus blue, okay, the inflation expectations divide. Okay, if you are a Republican, you think inflation's going down. If are a Democrat, you tend to think inflation's going up. And when you kind of split the difference, we do see a pickup in inflation, which the market doesn't like, and that's usually an enemy to stocks. But stocks can still climb in an inflationary environment if inflation means that the economy is growing and that earnings are still expanding. Okay, then last week was a really good week for the S&P, and so it just climbed up, best week since November. Okay, then one chart that I found here is that stocks against yields have now fallen from an area that has tended to pressure stocks. Okay. Since 2022, it has not been a specific yield level that has hurt stocks because for years I looked at this. Well, what's the yield on the S&P? It's 1.4%, 1.5%. Instead of focusing on what the yield level actually is, rather, when yields move to the 80th percentile of their rolling one quarter range, currently at 4.66, The S&P struggles. And you can see it's charted down here where we're starting to come down after getting a pretty high reading right here. Okay, here's the intraday chart. And you can see where Friday's intraday range was not all that much. We saw a little bit more of an expanded range on Tuesday here where we opened up above R1. We immediately went up to R2, and then this looked like, okay, maybe we're running into some trouble, but it was enough to fill at least enough of this gap. And then the market just chopped sideways for a while. And so the open was really pretty quiet. That's where we see a lot of the initial gyration from. And then we just started to go back higher. We got back above R2. We got all the way up to 60.50, and that was the high for the day. Drifted down a little bit and then closed just a little bit below that. Intraday, we're up again in the initial overnight session here, way over here on the right-hand side. But the futures were pretty much flat when they started to open and then really started to gain some strength right after Europe opened and started to go up. And then there was a big downward move that happened, well, it would have been in the middle of the night. Um, it may have been some announcement of a tariff or a fear or something, and the futures just immediately went down, but then came back rather quickly, and we're able to recapture that. And then we saw the positive action throughout the day. Still looking good here with the large cap growth versus large cap value. The blue line's above the red line, even though they are on different scales. And we're holding up here. We're not really breaking out to the upside with our intraday growth to value for the S&P, but it's still holding up. And it started to look a lot better in the latter part of November. And that's when this was really performing well. And then we've been kind of chopping sideways ever since. And now it's more the rest of the market that's starting to participate, or the rest of the S&P is looking a lot better there. So growth was up a little bit more than value for the large caps, up pretty strong for the mid caps and for the small caps. So not a big change though on our end of day charts with small cap growth to value, seeing some improvement here with the index itself, and the growth to value ratio still holding up, even though it really didn't change in Tuesday's session. A little bit of an upward move here with the mid caps as the mid cap index is also showing an improvement. And we did see an improvement here with S&P growth to value. So this is still holding up pretty strong, and this is what we want to see in a more solid environment. Not looking really good though when we compare the growth versus value ETF. We're still going down with this ratio, coming a little bit more down into the rainbow right now. Discretionary is still looking really solid compared to staples, and that's another positive area. And we'd like to see this doing well when we're more positive on the market. Large cap growth continues to go up. It recaptured its 50-day moving average and has been bouncing back up. And as far as our trend, we're now a little more decisively positive. We saw the green line cross above the red line. That's positive. And while this is happening, that's why we're seeing the ADX coming down. We're actually dropping a little bit below 20, which is technically a non-trending environment, but it is turning positive. These lines were just barely on top of each other after Friday. Now it's looking a little more decisive. And in the short term, also dropping below 20, going into a non-trending type of an environment as the ADX adjusts, but it is switching more over to positive. And volume continues to be above average. So here's our weekly chart. Look at sentiment where we're coming out of the neutral area and coming back into closer to greed. This is a composite where I look at something that changes multiple times each day. This is a weekly chart that takes a lot of different gauges and puts them together. And we're coming in right now at 61.68. The Ulcer Index is coming down, fears coming out of the market, but we haven't quite crossed below the moving average yet. And the VIX continues to decline, which is positive for stocks. We're going down with the line chart and the bar chart. The VIX of the VIX also declining, hasn't quite dropped below the moving averages yet. The momentum for the VIX is down, which is positive for stocks. We're still getting a high reading here. I thought, okay, maybe after this option's expiration, the SKU index, which uses out of the money call options to be calculated, I thought since a lot of those options had expired, that this would drop down. So much for trying to use logic to determine these things. The market is still expecting some kind of a big move, but we've been up in this red area now for quite some time. We are seeing fear coming out of the market as interest rates are going down and stocks have been going up. So we're going down with this fear gauge as well as the other fear gauge. So we're seeing confirmation of fear coming out of the market. But we ticked up a little bit here with the equity put call ratio. Now, over the weekend, these charts just would not update. These are the last charts I get that update. And sometimes, excuse me, sometimes I have to delay recording because I'm waiting for these charts to update. We ticked up a little bit with the equity put call ratio on the daily side, but we're going down with the 5-day and the 10-day as well. And that's more positive. That also means fear has been coming out of the market in a little longer term, 5 days and 10 days using a moving average. Volatility risk premium also continues to decline as fear has been coming out of the market. Now we want to keep an eye on this. If fear continues to drop, maybe it's getting where the market's a little too complacent. The advanced decline line studies looking more positive here. We have not exceeded the previous high yet based on price or volume. We're above the moving averages, so this is looking much more positive. And we're really seeing a nice little breakout of the new highs and no real expansion of the new lows for the S&P. So we're going up with the 5-day and the 10-day. This is internally showing some strength building. We're also looking positive with our short-term and intermediate-term advanced decline ratio. The blue line and the red line are above zero and going up. And this breaks that out. The top part is 19 days based on price, which is positive. And then there's also a volume reading here. We finally were able to cross back above zero with this. So we're seeing things look positive here. And here's our first smart money indicator, accumulation distribution. We barely ticked up after Friday. We're starting to go up, possibly getting a little far away from the moving average. But again, you can see by looking at it that we're not all that far away. But this is positive when we're above the red line. We were going down after Friday with the chicken money flow. This is smart money indicator number 2, and that was causing some concern. Well, the histogram went up in Tuesday's session, and the red line is going back up. And we were going down with the chicken oscillator, our third smart money indicator. It's now turning back up. So we're seeing more confirmation there with the smart money coming in and buying. We're right kissing each other with the red line and the green line, but this is virtually turning over to positive now with the vortex. It's not quite there, but especially if we have another update on Wednesday, this will probably cross over positive. And we're seeing an improvement with the accumulative advanced decline line based on price and volume for the S&P. This is one of the areas, maybe a little bit of a caution here with the advanced minus decliners and a 10-day moving average of that. We're continuing to go up here. When we get above this red line and we top out and start to come down, you can see. Now, it doesn't mean we'll reverse, but it could mean that we slow down for a bit. And then up here, this did mark a reversal. And then we had some really high readings, but the market didn't really go anywhere. And then we saw a bit of a decline last, is that end of August into September. So we're getting up to this area again where we might see a bit of a sideways action if we continue to stay positive. And then the advanced decline line for the NYSE and comparing that to the S&P. We did bounce off the 200-day moving average and we're showing a lot of improvement. It was able to get back above its 50-day moving average. And we are finally getting back to positive here. This is longer term, a 10-day average of the highs and lows for the S&P. We came back above 50, so that's looking better. And then we look at the broad market, the NYSE cumulative advanced decline line, really going up, looking solid. And with our regular NYSE advanced decline line, we've been able to get back above the moving average. So that's more positive. We're also above the moving average with this other NYSE advanced decline line. Then we break it out based on common stock here, going up based on price and volume, actually exceeding the previous high here. Now, that could be seen as positive because volume is setting a higher high here. We haven't quite seen that confirmed based on price, but that could be positive because it's quite often it's more positive when volume leads price. We're turning back to positive with our advanced decline line studies, going back above the moving average with all of the indexes that we follow, where we had been more negative. And this is also broader market and longer term, the 5-period moving average of the highs and lows, we're getting back above zero now. So that's also showing broad market improvement. This is another one just to be aware of. The stocks inside the S&P above their 20 period moving averages going above 80 now. Now we can go higher than this, but you notice when we get up to these high readings, sometimes we stall out. It doesn't necessarily mean a reversal, but it may mean some kind of exhaustion. But this is positive. We turned positive when we went back above 70. We set a series of higher lows as we were coming up out of an extreme negative reading, and we're going back above 70. But when we get above 80, it's like, okay, let's be a little concerned here. And then stocks above their 50 period moving average, back to positive. We're above 50. We're above 50 with the 100 period moving average and going up and never dropped below 50 with the 200 period moving average study. Short term, coming up to this pivot point here, and that could be providing overhead resistance right at about the 60-50 level here, but we're well above the 50-day moving average again. That was kind of a big deal to recapture that, and we are above average with volume. This is what I've been watching is more of the chart pattern. And I continually say this. I don't draw triangles or wedges or pennants or whatever. I just don't see a lot of success in that, at least on a consistent basis. But I do follow what are the bars themselves doing. And we were seeing a series of lower highs and lower lows here. Well, we got above that, at least on an intraday basis after Friday. We're continuing to go up here. And so we took out this previous lower high, so that's good. And we're back up to this previous high. If we can continue to go up, it would negate this negative pattern that we're seeing here. And then over the weekend, I showed the weekly chart where this bar for this week so far wasn't here. We were also seeing a series of lower highs and lower lows on the weekly bar chart. Well, if we can stay strong here, we've already broken above these previous two bars and keep going up. That would negate this negative pattern that we've been seeing here. And then longer term, from the October 2023 low, we came down. This was the end of the world low that we set last summer. And then we held on to that. So this is positive too. We came down to this trend line and we're able to bounce up off of that. We're seeing a big improvement now with our short-term trend based on 20 periods. We're above both lines and both lines are starting to go up. If the green line continues to go up faster than the blue line, that would mean the momentum is really solid. And we're above the 20 period simple and exponential moving averages. We were able to recapture that. And you can see we're getting kind of far away here. That's what the boom indicator is picking up. Here's the rate of change going back 5 periods. Now we could go higher than where we're at right now. But when we get above this blue line, again, it doesn't always mean a reversal, but it could mean a slowdown. This is the boom indicator, suggesting that we're getting kind of far away from the 20 period moving average, but we're improving with our distance from the 50. And also, we never did go negative because we never dropped below the 200-day moving average. But this chart is showing a lot of improvement, but maybe in the short term, a little extreme positive. Going up with the 20, just barely under looking extreme. Now, these are moving averages on the S&P itself. We're going up with the 50 and the 200. Then we have our usual charts, the Stochc RSI, extreme positive, but it can stay up here. Excuse me, it can stay up here for extended periods of time. The same thing is true with the Williams percent R, the CCI 14, and the CCI 20. The stochastics in the short term were extreme. We're becoming extreme in the intermediate short term, and we're turning positive and trying to cross above the midpoint here with the long-term stochastic. Now, this is a further subdivision of the short-term time frame. So don't think when I say long-term, that doesn't mean months to years. That means days, possibly weeks. Then the force index, not quite extreme yet. It's getting pretty close to this upper Keltner band here, but not quite there yet. And we're into the +2 channel with our standard deviations chart. When we start to get extreme, is if we go into the +3 channel. And we're improving, but not quite back above zero with the balance of power. This is the CMB composite. We're just up to this black line. Now, I put this black line on here, but I use this as a guide to say, okay, when we get above this, it doesn't mean a reversal. It just means that maybe we're getting overextended. And the go no go is still brown. It hasn't switched over to positive yet. It would have to be dark blue here for it to turn more positive. Now, these could redraw. That's one of the reasons I don't use this. I want a chart to tell me what's going on right now. Don't change color and say, oh, yesterday you should have done this, where yesterday we were telling you not to do that. Same thing is true with Elliott Wave software that I've used in the past. It can go back in time and redraw things and tell you exactly what you should have done, but was not telling you that at that time. Highest high value getting back up to the blue line here and above the midpoint. The midpoint is starting to turn up, so that's improving. We're just barely starting to go positive with the TTM squeeze. And we're going back up with our standard deviations chart. We had dropped below the moving average. Now we've been going up rather quickly here. So that means we're going above the moving average. This measures speed, not direction. Ease of movement is still negative, though. It's the one thing on our list that's still negative. Has not come back above zero yet. The Aron is still almost extreme negative now, but this kind of is a lagging indicator. It doesn't really do anything, and then all of a sudden it wakes up and then just shoots in one direction or the other. This is another one. This is the S&P McClellan oscillator, getting a very high reading here. We haven't seen this high of a reading in over a year, at least on this chart anyway. And you notice when we get a high reading, this did mark a top. This marked a slowdown with a series of lower lows before we declined. This didn't quite get extreme, but we were able to keep going up from that as the McClellan oscillator was going down. So we want to be aware of this, that maybe the market's overdoing it on a short-term basis, but we're going up with the summation index based on price and volume. That's positive. And we're starting to get extreme with the McClellan oscillator for the NYSE as well, but we're going up with the summation index based on price and volume here. That's positive. The Swenlin trading oscillator starting to get extreme. And again, this marked the top at this point. And then sometimes when we get a really high reading, that can mark some sideways action. We're not extreme based on volume. We're still positive there. Momentum is shifting back and pretty much turning positive, at least in the short and intermediate term. The PMO is crossing back above its moving average. We've already been positive now when you break this out based on price and volume. They've been looking better faster than the PMO itself was. We're getting extreme with the PMOs that are rising. Again, look at other times when we had really high readings. Didn't mean we turned and went down, but it quite often, sometimes it did, but quite often it just means some kind of an exhaustion. And we're going up with the buy signals and we're going up with the PMOs that are above zero. So this is positive, but possibly getting a little too positive. Slope, the short-term oscillator that we use, is positive. We're turning positive and going up with the MACD. So in the short and intermediate term, we're back to positive. I have two short-term oscillators, three intermediate-term oscillators. Those are positive. We're turning up and trying to improve with our long-term oscillators, the TRIX and KST. And the copy curve, another momentum oscillator, is positive. This is where we're getting above this red line with the Sean trend meter. That's the initial overbought reading. If we get up into the kind of different looking green here, then that would be more of an extreme reading. And this is more intermediate term. The money flow crossed back above 50. That's positive. The ultimate oscillator is above 50 and advancing, which is positive. We never did drop down below the moving average with on-balance volume, and now that's starting to go back up. We're above 50 with the RSI 14 and the RSI 9. So short and intermediate term, this is looking more positive now. And the Pring bottom fisher, which from all it looks like right now, this was quite a valid signal that it gave us. It actually crossed over and gave the signal before we started to go up. So it picked this up and we've been going up since that time. And we're positive now for the second trading day with the parabolic SAR, a primary indicator that had been negative has now switched over to positive. We're positive with the Elder's Impulse system for the S&P. We're getting above the blue line. We're showing a real improvement with the intermediate term trend. It would be even more positive if we continue to go up to see the red line cross above the blue line. That would show more momentum. And we're above the 50 period moving averages now. We were able to recapture that in Friday's session and then hold on to it on Tuesday. We're above all the plotted moving averages, so the longer we stay above this, the more all the lines will turn up. And if we can stay there for an extended time, these lines will smooth out. But the bullish percent index crossing about back above 50. Now it was already positive since we were going up and we were above the moving average, but now it's even more positive. And this is the point and figure charts or point and figure buy signals that are being generated inside of the point and figure chart. Crossing back above 50 with the bullish percent index for the NYSE and the NASDAQ 100 BPI. And I just wanted to show this again, mainly for the rainbow, the little mini rainbow. This is the short term, but it can also be used somewhat intermediate term. We were hitting resistance points when we look at a 20 period simple moving average of the open high, that's the green line, low and close. We broke above that, and the longer we can stay above this, the more these lines will turn back up, and that would be more positive. We're still negative here. We haven't seen the blue line cross back above the red line, at least yet. The green line's going up. That's more short term, and it's really hard to see because it kind of hides itself in price. But we're coming further up out of the Ichimoku cloud. And we're coming back up to the top end of this trend channel. Is that going to present some kind of a problem here? Because we hit that level, and then that's when the market started to have some problems after we set that all-time high in early December. We are positive with the Heiken Ashi chart with open candles. We're switching back to positive with the Kegi. We've turned black and are pointing up. We're also turning back to positive with the Renko chart, and the three-line break has an open candle. So we're looking good on a trending basis with our trend-based charts here. And we had a new X. I pointed out over the weekend, this might be causing a problem. We were hitting this high point here and not able to get above that with the X's. Well, we saw just enough of an up move on Tuesday to draw a new X in here. And we're going up longer term with our 150 and 200 period moving averages. And we're positive across the board on all time frames with all the indexes that we follow. We're turning more positive in the short term with bonds based on price, but still negative in the intermediate and long term. Commodities are positive across the board. The dollar, even though it was down pretty severely in Tuesday's session, it's still positive for right now. The only sector that was down was energy, which can often be more defensive. And when we start having inflation fears, industrials, which had been lagging, they were the strongest. Real estate, you can see communication, tech, and discretionary, they were up, but they didn't outperform. And financials were also up. So these are the three areas, and then four if you include financials, that we really like to follow. When these are leading the pack, that helps the S&P to really go up. We're just seeing more of the rest of the market showing an improvement. And try to figure this one out. You start at the bottom and read up. We actually had two signals, two alerts that were generated on January 20th. The market was closed. Okay. I don't know how come those were signaled, but we had a BPI cross below 50 with energy, and we had an S&P bullish MACD crossover for the S&P. When that happened, okay. Not, I was watching things. Nothing changed hands. That was closed for MLK, and then we also had the inauguration. So then we had a couple other, the NASDAQ going above 19.5, 19.6, and then above 19.4. When did all this stuff happen? The market was closed. Anyway, then we get into the 21st, and we see a lot of positive things happening, but the NASDAQ pulling back initially between 19.6. All right, seeing an improvement here with the equal weight and the weighted version of the S&P. They're getting closer to each other, even though they're on different scales. And this just shows that the rest of the market is starting to participate in this upward move. We were able to get back above the 50-day moving average with the Dow. So that's positive, and that's turning the Dow more positive. We're positive with the diamonds with the Elder's Impulse system. The NASDAQ and NASDAQ 100 lagged. Now they were up, but they underperformed in Tuesday's session. We're above this pivot point, above the 50-day moving average. So still looking good though anyway. And the NASDAQ 100 also up 0.58% above this pivot point, turning things more positive that way. We are positive with the Elder's Impulse system for the Qs. The momentum, finally, for the NASDAQ 100 is starting to cross above its moving average. It's turning over and looking positive. Small caps coming right up to their 50-day moving average. Now, is this going to mean something? Is this going to act as continued resistance for small caps, or are we going to be able to get above that? And also coming up to the 50-period moving average with our other small cap index, the Russell 2000, it has not been able to clear that at least yet after bouncing off of the 200-day moving average. We're positive with the small cap index here with the Elder's Impulse system. We got above, a little further above the 50-day moving average with the mid caps. Now we're potentially running into this R1 pivot point, which may act as overhead resistance. We're positive with the Elder's Impulse system for the mid caps, and we're getting a little further above with the Wilshire. This is a broad market measure that we finally were able to get the 50-day moving average after Friday, and we've been able to hold on to it for right now. Also, with the total US stock ETF, also going a little further above, actually 1.02% above the 50-day moving average from Friday's close. And this is also, I'm taking as positive. We were able to recapture the 50-period moving average with the bank ETF, where the financial sector has been doing quite well in and of itself. It had been seeing some weakness, but now it's starting to show some strength again. The FANG index, which used its 50-day moving average as support, has now been bouncing back up off of that. It'd be nice if this went up. We want to negate this series of lower highs that we're seeing right here and kind of lower lows as well. And this longer term trend line did act as support. If we continue to go up, we'll be watching this shorter term trend line. And Amazon was up over 2%. Apple, that was the one, the holdout. It didn't have a good day. It was down over 3%, coming close to its 200-day moving average. Google was up over 1%. We had Microsoft down 0.12%, not really performing all that well on Tuesday. Meta was up 0.6% above its 50-day moving average. Nvidia was up over 2%, coming back up to its 50-day moving average. Tesla was down 0.57%, still above its 50-day moving average. Netflix was up strong. They had I think, a bunch of new subscribers or something, some news popped out of Netflix that was positive and really sent the stock up. We are seeing an overall decline when we look at staples, which is defensive versus tech. When this is going down, that's more positive for the market. And we're also seeing kind of a leveling off of the correlation between world stocks and US stocks, but longer term, they're continuing to get stronger. Oil has been coming down. We got up in close to this 80 level. We were in the high 70s, and it's coming down, at least for right now. And the semiconductors had a good day, up 1.6%, trying to break out above these previous highs, but we haven't really done so convincingly yet. It's a little more apparent here, where we have this high, this high, this high, a little bit above it now. Are we going to be able to keep going? That would be even more positive for the semiconductors. The Dow Jones Semiconductor Index also having a nice day in an uptrend. This is the one that's in a downtrend, the SOX Index, but we're above both the 50 and 200-day moving averages. The longer we can stay above this, the more we might see a golden cross if that continues. And the semis did outperform tech, so we're seeing this ratio going up, and that's more positive for the market. The dollar really fell. We're in the 109 range. Now we're coming back down into the 107 range, and that's also helping stocks to go up. They like a weaker dollar. We're coming down with interest rates. Stocks really like that for right now, too. And we're going up with price of bonds right now, even though we generated a recent death cross here. And we're getting a little bit further above the 200-day moving average with the total bond ETF. So that was support that looked like it had been lost. It was lost, but we've been able to recapture that for right now. We're seeing an improvement here, not much. We were actually down a little bit on Tuesday, but when we look at home construction, the 3 to 7 year bonds, we've been watching this. First, we were watching it to see if the support would hold, which it did not. And now we're starting to come back up. If we continue to improve, we're wondering if this may act as overhead resistance with this ratio. And we're watching this chart. This is a weekly chart of international rates for the 10-year bonds around the world. We're watching the red line. This is Japan. If interest rates, which were down, keep going up here, that's what caused all the panic that happened last summer. So if these come down, that would be more positive. If this goes up, that may cause some problems. And still holding up okay here with our growth to value ratios, Qs to S&P, right on the moving average. a little bit above the moving average with discretionary to the S&P. We're still under the moving average as values lately has been outperforming growth for the large caps. So we're under the moving average with the large caps, above it for the mid caps and the small caps. Continuing to go down here, which is positive for the S&P. This means staples are underperforming the S&P. So what's our outlook for Wednesday? We are dealing with earnings season, and sometimes that can have a real impact on things. We're positive right now, technically, but we're becoming short-term overbought. Doesn't mean we'll reverse, but it may mean that we slow down. And we're going to get the MBA Mortgage Applications Index and LEI, or leading indicators, will be coming out. And then all the geopolitical things, with things still focused on the new administration, on all the changes that are taking place there. But that could change at any time with something else coming in from the outside geopolitically. And then on Thursday, the big thing will be initial and continuing jobless claims. And then Friday, we'll get the global U.S. manufacturing and services PMIs, existing home sales, and consumer sentiment, which are important, but not necessarily market drivers. All right, then Thursday is the next day that they have for big economic reports on this calendar. Seasonality, not much of an edge either way. We're actually negative for the 22nd with the Dow, neutral to positive with the S&P, and neutral to negative with the Nasdaq. And we're now in the week after options expiration, which tends to be positive. We're up 62% of the time going back to 2002, and we're up or down 38% of the time. And not really seeing much of an edge here with the green dashed line as far as seasonality in a post-election year. Then you look at the blue dashed line here. This is the Nasdaq. It should be doing a lot better. I mean, it's doing good. It's not that it's doing terrible. It just didn't perform as well on Tuesday. And now we're into the second half of January, which tends to perform well, but usually not as good as the first half of January. And small caps are improving now, but they should have been improving. It should have been well underway, where now it just looks like it may be getting started if it can continue to go up. We're still in this negative time. We have one more day here, according to Tom Bowley's research, before we head more into a positive time to finish out the month of January. So the warning signs, this is it. And this is when I get concerned. When we only have one thing or nothing on our negative list, that it's like, okay, things are firing on all cylinders, everything's looking good. That's when I get a little bit nervous, but this could still last for a while. But then on the positive side, we're back over here with our smart money indicators. When we take them together, they are now positive. Growth to value is still holding up. Discretionary still doing well compared to staples, and that's positive. We're going down with our 5 and 10-day equity put call ratios. The advanced decline lines are looking much better and turning positive. We're getting extreme with the McClellan oscillators with the S&P and NYSE. That's a bit of an extreme. That's more short to somewhat intermediate term, where we're still positive with the summation indexes. And we're turning back positive, except for the long term with our oscillators. But short and intermediate term, the momentum has switched back to positive. Parabolic SAR is positive, the Swenlin trading oscillator, but we're getting kind of extreme based on price. And our bullish percent indexes, also positive for the ones that we look at. The vortex, they're right on top of each other, but the idea is that it's improving, so it could be turning positive. And our moving average studies are positive, but we're starting to get extreme with the 20 period. Money flow is positive, ultimate oscillator positive, and we're turning positive with the momentum for the NASDAQ 100. And the financial sector is also positive. So our conclusion, we're positive, but in the short term, we're starting to get extreme. Now, we doesn't mean we're going to stop here, but we may slow down. Then we are positive, but overbought in the short term. Intermediate term, we have a little bit longer list that's becoming extreme positive, and we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.